Hello everybody, the Bank of England has just raised the base rate of interest by 0.25% to 4.5%. This is the 12th consecutive rise in rates since December 2021. It's the highest we've had these rates since 2008. Today I want to unpack what this means for our personal finances. I want to look at what it means for your mortgage, your debts, for first-time buyers, for people who are looking to invest in property, for people who are looking at their debt, for example, their savings, their investments. I also want to look at what it means for small and medium-sized businesses. Now, this rate rise comes on the back of other rate rises in America, the US Fed, and the ECB in Europe also increased rates by the same rate of 0.25%. So I want to unpack what that means for us day to day. Before I even go into that, I just want to say that I acknowledge that this is a difficult time for a lot of people, a lot of households right now, and these rate rises feel very frustrating, although I know they need to happen because we have inflation as a big problem in the UK and in different parts of the world. But in reality, the true reality of this is that this is really hurting a lot of people because people now need to go and find that money, and it's creating a lot of financial anxiety. So I just want to stress that I fully understand where you're at, and I honestly deeply sympathize with the position where you might be in, having that need to go and find that money every single month as these rates rise. So I'm going to look at my notes here because I've made some notes to help to guide me as I go through the various stages, just to make sure I give you accurate information. The MPC, the Monetary Policy Committee, a group of 9 people who sit together periodically. The last time they sat together was in March. They sat together again in May to make this decision. 7 of those people voted for a 0.25% rise to 4.5%, and 2 other people actually said they wanted to keep the rates the same at 4.25% as it was before. Okay, now let's look at the different segments of how this is impacting us. First of all, let's look at the UK economy and what's going on right now from a UK economy perspective. The Bank of England actually expect the underlying UK GDP, so gross domestic product, they're expecting it to grow by around 0.25% in both Q1 of 2023 and Q2 of 2023 compared to previous expectations back in the February report of negative growth. This is a huge change because previously they were expecting things to go in the other way. But now, although the growth is modest, it's a positive result. Okay, this improved outlook reflects stronger global growth, lower energy prices globally, and also the fiscal support that came on the back of the spring budget not too long ago. So effectively, the UK economy has turned out to be a lot more resilient than expected, but it's worth mentioning that the level of growth, although the numbers are positive, is still very weak in comparison. Now, if we zoom out a little bit, although we are seeing that improvement in growth from a GDP perspective in the UK, the big picture is that the UK remains, from a forecast perspective, the UK remains has the weakest growth and the highest inflation across the G7. This, my friends, is the big picture. Okay, so on one hand, things are improving, but we have to keep the bigger picture in mind, which is that actually, relative to others, we're not doing as well as we might think. Let's now look at inflation, which is the big topic and the big driver for a lot of these conversations. The Bank of England historically told us that they expected a sharp fall to inflation this year to a sustainable rate of around 2%. This is this dreamy 2% number that they've always had as a goal. Now, however, this is actually not playing out in reality. Okay, CPI inflation, consumer price inflation, was at a really high number, 10.2% in the first quarter of 2023, higher than expected at this time in February and in the March Monetary Policy Committee meetings. They described this as an upside surprise. The upside surprise in these inflation numbers came from higher than expected numbers in clothing and food prices. Okay, now what's interesting about the food price one is that they observed that the rise in food prices is similar to the rises we've seen across Europe. Okay, I'm not sure whether that's good or not, but if you're feeling the pinch, then boy, you know, the reality is that prices are rising. Whether it's the same in Europe or not, the reality is in the UK, we are really feeling the pinch from a food price perspective. Now, what's really interesting about the food inflation thing was that they said it's more persistent than normal. In fact, they said that food price inflation has reached a new historical high of close to 20%. Okay? Now, although they expect this to gradually slow down, of course, they would tell us that they expect this to slow down as it takes some time for changes globally in energy pricing and things like that to feed through the supply chains. These things take time, and I understand that. I want to make sure you understand that although they expect these prices to fall, actually, let me reiterate that. Although they expect the food inflation to fall, this does not mean that the price of food will fall. This just means that food inflation is not rising as fast as it was doing before. Okay? The other component of inflation is that there has been a significant fall in energy prices. So it looks though basically that when they look at all their indicators, so indicators from households, indicators from businesses in the UK, expectations are essentially that inflation is fallen slightly, but still at an elevated level. So it's still higher than they expected. Yeah. So overall, although energy prices have declined and all those other elements have declined, clothing and food prices remain persistent, which means that if inflation remains persistent, i.e. it still remains high, still remains in double digits or maybe a single digit high number, it means that this conversation around interest rates will carry on for quite some time. Which is not very good news, because it means essentially that there is definitely going to be more interest rate rises down the line. So we're going to be expecting more rate rises in other times in this year and in the future. Now, looking at interest rates, I've covered inflation. Look at interest rates there. What was really interesting watching the Bank of England deliver their live update, in addition to me reading the Monetary Policy Committee minutes of meetings, what was really interesting was that they said that they are not giving any directions, any steer on rates this time around compared to in March. Yeah. What was really unique was that they said, we want to be guided by the evidence. However, when I read their minutes of meetings, it did state on there though that there's a market implied path for the bank rates, yeah? And they expect it to peak at around 4.75% in the fourth quarter of 2023. Okay. Overall though, I want to say when I watched these minutes, when I read the minutes of meetings and watched them live delivering the news, the one thing I noticed though with the Bank of England was that they had this quite defensive tone. It's the tone I got around their forecasts, because they were being asked these questions by, I guess, journalists and so on. And one of the guys who were on the panel said something interesting. He said, I want to make it clear that the forecasts that they put out, are conditional forecasts, which means that when the conditions change, so do the forecasts, which kind of made me think, what's the point? You know, because if the whole point of us listening to all these updates is because we're kind of listening to these people who have a lot more data than we have, they speak to more people than we do. They have all the inside knowledge on what on earth's going on. We kind of expect them to giving us some guidance, but they're effectively saying, no, we're being, these are conditional forecasts and we're just going to be led by what's happening. Yeah. The other thing that came across from me is that they just seem quite desensitized from the reality. As far as they're concerned, they just want to announce this thing and go, hey, here's why it's happened. And yeah, go and figure out how you deal with your personal finances, which I thought, you know, if I had to speak to them directly, I'd say, you know, you really want to be focusing on the true reality, which is that people are struggling. Like these rate rises are not a joke. Yeah. Each time you go up by 25 basis points, 50 basis points, there are people feeling the pain. Okay. Rather than just focusing all the time on, here is our sustainable rate of inflation target of 2%. Yes, it would be lovely for us to get there one day, but let's not forget the reality of households who are struggling financially during the cost of living crisis. Let's now speak to mortgages and rents. Now, if you are on a tracker or variable mortgage, over 1.4 million people will see an instant rise in their mortgage payments due to this rate rise that was announced today. Okay, I've worked out, I looked at my mortgage calculator and looked at a scenario for someone. Imagine you've got a mortgage of £250,000. I just use that as a number, a simple number to work out. If you had that, a 25 basis points, that's a 0.25% rise, which we've had this time round, will result in a £36 per month increase in your monthly payments. Okay, that's the reality of what that means for our pockets. Now, a big dilemma a lot of people have right now is, should I be fixing? This is an ongoing dilemma because these rates keep going up because inflation remains persistent. And we already can tell what will happen next time in June, which is that they will increase the rates yet again. So should you be fixing? The biggest conundrum is, should you go for a 2-year fixed or a tracker? Now, the reality of this is that this is actually a personal decision. Because the more you wait, the more likely it is that rates might start to fall down the line. But at the same time, it also feels like, you know what, it still feels quite far away because inflation remains quite persistent. Yeah. So I think it will really depend on the extent to which you want to be able to predict your monthly payments. Like if you want to be able to see your monthly payments and say, you know what, this is how much I'm paying, this is my budget, that's it, then you want to try and maybe focus on a fixed rate product. But again, that is really the big thing. I think it's a personal thing and I can't really tell you exactly what to do, but I think it will really come down to the degree to which you want to be able to predict how much you are paying on a monthly basis. Now, when I looked at some of the rates, I went to the website Money Facts. I'll tell you what some of the rates are at the moment. When I looked at May 2023 compared to March 2023, when we had the last update, a 2-year fixed right now, you can get for 4.19%. Yeah, this is some of the best rates, 4.19%. On a maximum loan to value of 60%. This is as at now. Yeah. Back in March when I did this update for a 2-year fix, it was 4.26%. So the rates come down a little bit from 2 months ago. Yeah, I just wanted to highlight that. Now, if you are someone who is currently on a fixed rate mortgage, 75%, so 3 in every 4 people who have mortgages are on these fixed rates. But a lot of people will be coming out of those fixed rates, in the next 12 months or 24 months. So, in fact, it's estimated that over about 1.4 million people are expected to be affected once they come out of those fixed rates. What I would say to that is, if you are in that scenario, essentially what you want to do now, if you can, is obviously, maintain strict budgeting. You might be enjoying lower rates right now, but overpaying on your mortgage is what I would be doing if I was in your shoes. Now, there's a question I want to answer for you guys, which is, what if you are struggling to pay your mortgage? Like right now, these rate rises are going up. Like, what if you can't actually pay it? What should you do? The first thing I'd say is I'm actually very sorry if you are in that dilemma, because I know that's a real problem for people right now. A lot of people, thousands, would be in that position where they actually can't pay. The first thing I'd say is that you need to contact your mortgage lender, your bank. Contact them ASAP. Don't bury your head in the sand, because if you do that, what happens is you might end up with a late payment, and that's not what you want on your credit record, that you've had a late payment from a mortgage perspective. That has a big cost. Yeah. Speak to your lender immediately, and options could include things like a mortgage holiday potentially, which is not a real holiday. Obviously, it just means that your payment's deferred for a bit, but your monthly payment then goes up as a result of it. You might potentially be able to go on an interest only type deal, but again, that might be income dependent. And finally, you might be able to extend the term of your mortgage. Yeah, essentially, they can move all these various inputs around to try to accommodate you, because nobody really wants to repossess your property or anything like that. They just want us to get through this process, but communicating is a very big part of what will help you in this season. I want to speak to renters now. Now, renting there's been a lot of news recently for renters, and renters have obviously been struggling with rising rents driven by rising mortgage rates, which landlords are then having to, some landlords, actually not all landlords, but some landlords having to pass on, because they are also experiencing higher mortgage costs. Yeah. Now, one thing I want to mention with renters, you might have seen in my video that I made yesterday about the 100% mortgage that came out from Skipton with no deposit and no guarantor required. It's the first since 2008. If you've not seen that video, if you're a renter and a first-time buyer, I will link to that video below as well as above for you to head over and check that out and look at my pros and cons. You want to watch that. But one thing I would say is that you definitely want to pay close attention to, to things like that, because that might be your opportunity to potentially, not for everybody, potentially get onto the property ladder if that is what you want to do. Okay. And from a rent perspective, you might see rents rise if your landlord chooses to pass on some of these costs onto you as a tenant. Speaking to first-time buyers, now rates are getting better for first-time buyers. Okay, again, you may be a renter who's a first-time buyer, but rates are getting better. I looked again at Money Facts, the website I mentioned earlier, and when I looked at some of the rates as a first-time buyer, some of the best rates are for a 2-year fixed 4.41%. with a 90% loan to value though, yeah? When I compare that to my March update, it was 4.5% only 2 months ago. So those rates are a bit better compared to where we are right now. But as ever, as a first-time buyer, I always say, the more money you have, the more you can get better deals. So although you have that option of a 100% mortgage product that's just come out, I always veer on the, I always want to stand in a place where I'm much more cautious. You want to try and have a bit of skin in the game when it comes to you taking out a mortgage. So putting down a bit of a deposit always helps you and prevents that likelihood of potential negative equity, because, hey, property prices, might still fall, but who knows, yeah? If I was in your shoes, by the way, because I know some of you might ask me in the comments, if I was in your shoes buying the first-time buyer, I'm personally, it's just me, I'm not going to keep waiting. I will get onto that property ladder ASAP as soon as I can. But that's just me, people. Do what works for you, okay? But in all these things, please seek independent mortgage advice. Speak to a broker or someone who can offer you some advice, and so that you're not doing a bit of guesswork and so on. Take everything I've shared, but definitely make sure you get advice on top of that, okay? I want to shift gears now and look at buy-to-let rates. For the people who are interested in investing in property, perhaps you're working towards becoming financially independent one day, but you're keen on buy-to-lets and that kind of stuff. The rates are also lower. So I looked at May 2023 rates, a 2-year fixed rate at the moment. The best you can get is at around 3.69%. 3.69%, maximum loan to value of 65%, okay? Compared to my March rate, again, for 2-year fixed, back then was 3.99%. So those rates are better. And when you look at 5 years, at the moment, it's 3.99% at a 65% loan to value. So, those rates are not crazy if you think about it from a buy-to-let perspective. Okay, again, go and check out Money Facts. Now, looking at debt real quick, because debt's a big problem for a lot of people who watch our channel, and getting better, hopefully, as you watch our channel. Anyone on an existing fixed rate, personal or car loan, will not, provided you've had terms previously agreed, will not be impacted by the costs of these changes, these rate rises that have been announced recently, okay? That shouldn't really affect you, but it's worth mentioning that you had to have been on a fixed rate, obviously, with your personal loans and that kind of stuff. Now, with credit cards, the interest rate on your credit card or your overdraft could still go up despite no direct link to the Bank of England rate rise, yeah? If your lender chooses to pass on those rises to you for borrowing. So this is worth mentioning, yeah? But the thing to note is that your lender, your credit card provider, actually must give you notice before this happens, yeah? They wouldn't just like do that to you, do you bad. They wouldn't do that. But yeah, definitely make sure you are in communication. You're reading those letters coming through the door, because these things just show up either via email or via post. If you are in hefty debts though, I'd highly recommend thinking about, again, seek advice, but recommend looking at 0% balance transfer credit cards potentially as a way to kind of, manage your debt situation. That might be a thing to do. If you have bigger loans, much bigger loans, then you might want to consider consolidating those loans potentially, but again, seek the advice from a debt counselor. I want to look at savings real quick. On the face of it, the rate rise is good news. Obviously, rate rises are great for savers. You're likely to see better rates from the easy access rates perspective. Now, when I did the research for you guys and looked again at Money Facts as a place I wanted to look at this, you can take advantage of rates of around 3.71% for easy access accounts right now. Okay, that's higher than my March update at 3.4%, which is great news. However, what has not changed is the 1-year rate or the regular savings rates at 4.5% and 7% respectively. Those were the same for March and remain the same right now. But in any case, that's good news in a way. But remember, as we know, if inflation's at 10.2% and obviously your interest rate on your savings remain at around like 4.5%, you know, that's a negative return, right? And I know people talk about this a lot, but I'm just mentioning it because from a real rate perspective, a real return perspective, it's still negative, but it's still helping you, you know, chip off some of that, you know, some of that impact of inflation by you generating a bit of a return. Personally, look, I've said this before and I continue to say it. If you can, if you're thinking long-term, beyond 5 years, then you might want to use your stocks and shares ISA and the like to invest in stocks, equities essentially, or funds and so on, such that your money has that capacity to work harder for you. That's what I'm doing, but you know, think about doing that for yourself as well. In fact, I've made a video recently, which I'll link to below and above, for why you should absolutely be prioritizing your ISA now more than ever. So please feel free to check that out in your own time. Speaking to investments, my approach to investing has not changed since my last update. I'm still focusing on, I've still got a passive investing focus with a global perspective. Alternatively, I'm investing for dividend income. You know, so I'm looking for those dividend payers. Otherwise, I'm keeping it super passive, super cheap, super global. That is my focus. Now, I want to speak to SMEs because I've not done this in my previous updates, but what's the impact for small and medium-sized entities? One thing I would say is that the news today will obviously result in a level of stagnation from a growth perspective. And what we need in this economy, in this country, is effectively growth. We need a growth-focused direction because that's really what will get us all going. You know, productivity, all those things will all start to head in the right direction the more we focus on this growth agenda. So stagnation of growth is the impact for small and medium-sized entities. One other observation, obviously, is that the costs from inflation continue to be passed on by SMEs to households, naturally, but there is a challenge for small and medium-sized businesses in the cost of servicing business borrowing. Business borrowing costs remains a big problem. But overall, there remains sensitivities to pricing naturally as businesses continue to struggle in many ways, given the challenges of high inflation and the resulting rises in interest rates. Overall, I know that's been a bit of a marathon today, and I thank you if you've got this far in the video for being patient as I walked through these various different areas. Overall, I'd say that the update today indicates that there will definitely be future interest rate rises from the Bank of England. They've essentially pinned the direction of those interest rates on the direction of the UK economy. Although we've seen an improvement in the UK economy, slightly from a GDP forecast perspective, in honesty, the future of the UK economy remains uncertain. That is the best I can say, is that it remains uncertain, which means that, you know, anything can really happen. But one thing I know for sure is that there will be another rate rise. Yeah. What I would say more generally for us, households, individuals, you know, keep that budgeting going. I know it can be quite frustrating when you're struggling from an anxiety perspective, trying to deal with your household finances, but that diligence from a budgeting perspective will pay off for helping you develop good money habits, and will pay off from a long-term perspective the more you get adjusted to a particular lifestyle. So keep budgeting going, keep boosting your savings in every way you can. Explore different ways you can use your existing skill sets to earn more, learn more, acquire new skills if you can, as different ways for you to earn more. But essentially, you want to really keep that buffer growing and keep chipping away at that mortgage if you can, okay? And in addition to that, also stay on top of things at work, because although they forecasted that the unemployment rate is below 4%, so that's a good thing, you know, these things can get quite personal, and you know, unfortunately, as we've seen in the tech sector and that kind of stuff, lots of people do get made redundant, and that could become a reality. So we want to make sure we're prepared with an emergency fund and all those things to make sure that our families remain resilient in these times. Guys, the next interest rate update is on the 22nd of June of this year, and you be sure that I will be there to provide you guys with the update on what you should be thinking about and potentially doing for your personal finances. But overall, I want to summarize by thanking you and saying, do please make sure you look after yourself, look after your mental health, look after your well-being more generally, and yeah, do something fun as well. You know, don't let all these numbers and the heaviness of interest rates and that kind of stuff kind of weigh you down. Try and take some time out and do something that's enjoyable for you, and yeah, enjoy some time to yourself as well. Yeah. But other than that, thank you all for watching, and I'll see you on our next one. Take care, people, and bye for now.